my first actual good friend in this space that I've known for about as long as anybody in crypto. Matt Roszak, he's an investor who founded Tally Capital back in 2012. 2012, over 90 investments in crypto. Also the chairman and co-founder of Bloq, a really respected tech company. Next we have Mrinal. Mrinal Manohar is his intro. He's a computer scientist from Carnegie Mellon. Was working on his PhD, dropped out to kind of launch a traditional Wall Street career. He's got a background at Bain Capital. He's now co-founder of Casper Labs. Then we have Jeff Premer. Did I say that right, Jeff? Premer. Jeff Premer, the CEO, director, and founder of Vaultex, a regulated security token and asset exchange. And then rounding out my favorite story. One of the reasons that I loved the story when I first met you guys. So Mance Harmon, his background, he taught computer science at the Air Force Academy. Went on to manage the development of the real-life war games for the Missile Defense Agency. A lot of you guys might have seen that movie before. Anyway, that was Mance. Now he's the co-founder and CEO of Hedera Hashgraph. So let's give a little applause for the panel today. I appreciate having the chance. So I'd like to go my first question. Really, I want to go to Mrinal. So Mrinal, you come from the traditional finance world, private equity, Bain Capital, billion-dollar hedge fund. What would you tell your former colleagues about how they should think about this space?
Well, starting off with an easy one, I guess. That's a pretty expansive question. I'd say, look, the general reaction that I've gotten from my former colleagues and people on Wall Street in general has been one of three flavors. The smallest really is, interested, let's go after this space, and that's a real minority. And then there's two camps. One is fear, and one is disinterest. So let's talk about each one of those. The people who are scared of the technology, what I'd say is we're just witnessing the same story that's happened historically. When equities were first invented and we had the stock market, people at the traditional bourses were terrified that this would upend the industry. When the LBO was introduced in the 1980s, people thought this would radically change M&A. When algorithmic trading came out, people thought this is going to crush traditional investing. What actually happened out of these three things? Equities created a much more participation in financial systems. The LBO forced more adequate management resolutions. And algorithmic trading has actually stabilized the market and made participation more open. The lesson here really is new fintech comes along, and it doesn't really completely disrupt the industry. It augments it and makes it better. And I think that's what's going to happen in this space. The second lesson is the people who took these innovations and embraced them were the ones who were most successful in times of disruption. And that addresses the second part, which is disinterest. I'd say you should be interested in this industry because the triple whammy of the best form of asset copy protection we've ever seen, public access and public ownership of the financial system, and the ability to algorithmize and automate a lot of contracting processes is extremely evocative.
That's a good response. I'd like to take the next question over to my friend Mance. Mance, what part of the economy do you view as ripe for disruption by public ledger technology?
Well, if we look at a significant growing sector of the economy, we could point at the gig economy, the economy of those people that aren't W-2 employees. They work for some type of platform that does the matching of service providers with service consumers, and they use that platform to make a living. And in the United States, more than 60 million people are 1099 employees, not W-2 employees. And that's just the US. Globally, it's hundreds of millions of people. And if we look at what's happening with those platforms that do the matching of the consumer with the provider, they're taking a huge cut of the payment that is being made because of that matching service that they're providing, an inordinate amount of money. And so I think that that part of the economy is ripe for disruption because the distributed ledgers, in their nature, disintermediate centralized organizations. We can use public distributed ledger technology to create a fully decentralized Uber or Lyft or Airbnb or you name it, and make it possible for those developers that want to build these distributed equivalents to do so far more efficiently at a lower price point than what the centralized organizations are able to do today. And so if I were going to point at any one part of the economy that I think is really exciting for disruption using this technology, it would be the gig economy on a global basis.
I wonder, that's a really good point. I think disrupting the middleman from buyers and sellers is kind of a natural.
What we can do is create distributed markets. And the gig economy is nothing but the formalization of centralized platforms to enable markets. And there's no real compelling reason for there to be a single organization that is providing that matching service. It should be distributed, and it would make the markets themselves more efficient, which is exactly what we want, is for an economy to be as efficient as possible.
Got it. Thank you for that. I've got an interesting one for Jeff. How can distributed ledger technology be used to eliminate settlement and counterparty risk for exchanges through cross-chain clearing?
Well, for an exchange, that is the largest risk, is payment settlement and clearing. So if you have all of your asset digital certificates on a blockchain and you have a currency that's on a blockchain, then you can do instant settlement clearing without any risk. So this will eliminate all the systemic risk that's involved with HFT manipulation, all these kind of things, because everything is just instant on chain through the order book.
And will that do anything with what we hear about now with wash trading and front running and?
Yeah, it can. Yeah, as long as the data feed is transparent.
Yes.
And everyone has equal access, then everything is cleared instantly, and you can eliminate these problems.
Okay. I think that's an interesting one. So I'll circle back to Mrinal, and this one I'll ask a couple of you, because I know, Mance, you've got some more than a little bit of security background. But what do you think about some of the concerns around hacks and security, like the recent Binance hack? How do institutions get more comfortable with this overall industry?
So, not to start with a hedge, but I would say it's definitely not a good look, but I think people should put it into context, and I think people tend to overblow what they actually signify. So if you think about Bitcoin itself as a protocol, the protocol itself has never been hacked. Blaming Bitcoin for a wallet being hacked would be equivalent to blaming TCP/IP because someone got into your email address. When someone gets into your email, you don't say, the internet's broken, TCP/IP is broken, that service provider happened to have something that went wrong. And so when you put that in context, the equivalent would be, when Apple's iCloud got hacked, people said, oh, the cloud storage model is broken, I'm never ever going to use it anymore. I think the reason why it gets exacerbated within the cryptocurrency world is because the underlying technology also reads and stores value. People tend to look at it much more skeptically. Now, what I'd say is, as the industry matures, it'll get a lot closer to the real world where people are much more comfortable with things like this. You're comfortable with your bank, even though a bank robber can go and rob it, because things like insurance, FDIC, et cetera, exist. And over time, this will exist for cryptocurrencies as well. There will be insurance providers. People can do heuristics, build their tables, assess risk, and provide offerings that deal with all these problems off the chain itself. So I think overall they're a bit overblown, and as the industry evolves, people will figure out how to put these things in the right context. The protocols themselves are actually fairly rigorous and have held up, I would say, almost better than I would have expected initially.
Got it, got it. Would you like to add any color on that, Mance?
Well, so from Hedera's perspective, of course, we have a protocol and we're building a public ledger using that protocol. We view, if this market matures the way we all expect it will mature, then there will ultimately be trillions of dollars of value that are being processed on these public DLTs. And given that, and when there are mission-critical, enterprise-grade applications running on these same platforms, then there's expected that there will be a lot of attacks happening at that point in time that maybe aren't necessarily happening today. So given that assumption that it will be attacked, then our position is that you should start with the very best security at the protocol level that one can achieve. And there is a whole theory, 30-year literature of research and theory on distributed consensus. And there is a theoretical limit of what can be achieved at the algorithm level. It's something that's called asynchronous Byzantine fault tolerance, ABFT. And it's well understood, been understood for decades, that you can't do any better than that. So if we can build an algorithm that starts there, a protocol, a consensus algorithm that achieves asynchronous Byzantine fault tolerance, then that's the best building block that you can start with. In the house that you end up building using an ABFT brick looks very different than a system or house or global network than what it would look like without the ABFT brick to start. And of course, I'm biased in that Hashgraph is ABFT, but our position is if you're going to build something that is going to be the infrastructure for the next 100 years, then really you should start with a theoretical limit in terms of security that you can achieve at the protocol level.
Got it, got it. I'm going to take this one over to Matt. Matt, my first question to you today, your background is you've been investing in this space for many, many years. You've seen as many different projects and researched them as anyone probably just about in the world. With what you know, give me the biggest opportunities and challenges in crypto today.
That's a mouthful. That's a great question. And I think everything from the hacks, the recent hack at Binance, and in this space, those are some of the challenges. You look at how CZ and his team at Binance approached that, having a fund to pay off that loss, putting in systems, getting more resilient, and you create muscle memory. Everything from this perspective of Mt. Gox to all these other things. These are human-based issues, and so I think as time goes on, the notion of custody, wallets, exchanges get better, more resilient through this, and there is a operational issue in this space that continues to get better. This is not a static picture where it's going to stay like this forever. It continues to evolve and get better. That being said, I thought by now we would all be buying coffee and everything with Bitcoin 8 years ago. So we've got a long way to go. But the momentum is obviously there. I think those form factors are getting better, and we're seeing Fidelity and Bakkt and other institutions getting into custody, which is super important because people like the audience of Salt is going to pay attention to Fidelity doing custody. You and I could create a whippersnapper custody solution tomorrow, and when they go to the investment committee, they'll say, "Do I go to the whippersnapper
Matt
one
and Scott,
or Fidelity?" And so that will play out over time.
Sure.
And so you got, again, on the issues, you got some kind of core infrastructure things. You have regulatory issues that are profound right now. It's hard for any team on this stage or in this space to confidently build tokenized networks in the U.S. Everybody's setting up entities in Switzerland and Singapore and the Caymans, not because of anything but the lack of clarity. And so I think, at least in the US, the pendulum will swing once there's more value that's getting domiciled outside the US, more jobs, more innovation, and some of these trillion-dollar layers that wind up lighting up. And then thirdly, on the issues is perception. Again, these hacks and all these salacious headlines kind of distance crypto from institutional investors. It continues to be a theme. And there's some people here at SALT or on Wall Street, Hong Kong, London that still use Bitcoin as a punchline versus seeing it as this incredible new asset and everything around it. So I think the perception continues to unpack and get better. In terms of opportunities, we're kind of talking about like what does this opportunity in the industry mean? This is a generational opportunity for entrepreneurs and investors. I haven't seen something like this being in tech and finance for 20 years. This is fundamentally one of the greatest things that I've seen to participate in, hence investing and building and advocating for this space. Seeing all these projects and the kind of store of value of Bitcoin, my sense is that layer has been won by Bitcoin. I think the network effects, the security, and all that will just kind of come into its own. And then you have all these other rails and protocols, all the Ethereum killers, some are on this stage, that want to build communities and build value and build functionality on those rails. And I think that's still to be determined, right? You have Ethereum, you have Cardano, you have EOS, a lot of top 10, top 20 market cap cryptos that are still have to prove themselves. And the space has been two flywheels, a speculative flywheel, and people kind of get bent out of shape that crypto has been very speculative. Speculation funds innovation. It's a necessary piece to it. The blockchain functionality, throughput, transactions, the utility, the bite of these networks is still to be determined. We have a lot of work to do in this space to show that at scale. And so, again, profound opportunity. All those issues that are outlined are being worked on. So that will come into focus over time between infrastructure, regulatory stuff, and perception. On the perception piece, in some ways, and I think that the panel will agree, many of us feel like that distance. I feel like we know something that the broader institutional investor community or the broader public doesn't know. Like this is happening. The building, the investment, some of the smartest people in the world are jumping into this space. And so as that kind of distance closes, we'll see another profound kind of jump in this space.
Got it. Great insight. I really appreciate it. Jeff, I have an exchange-related question for you, and this is something Matt just brought up, and it occurred to me that I don't really remember people talking about this very much. But at some point, I think it was in mid-2018, Matt, you might know this, Binance began to self-insure for all intents and purposes. They took a percentage of fees and put them into an escrow type of account in the event that something were to happen in the future. Something has happened. What do you think about the idea of exchanges self-insuring their customer deposits? Give me your thoughts as an exchange entrepreneur.
Well, we take the traditional approach to where customer deposits are kept in a segregated trust account managed by a trustee. So we take the traditional approach because that's pretty much what a regulator is going to want to see. So for an unregulated market like crypto, that's probably a good approach. For us as a regulated entity, that's not an appropriate approach. We have our capital requirements. And we're essentially responsible if there's a hack or any issue. And that's why we have to have sufficient capital to cover that.
So from the regulator's standpoint, the way you would look at it is they've already built in the rules for security token exchange backing, I assume.
The basic framework is there, correct. And so the security token custodianship is also held by a licensed third party, separate from the exchange entity.
I think the point you're trying to...
Similar to fiat, similar to the way fiat is held in a traditional exchange.
Yeah, and I think the point you're trying to drive at is it's amazing where you have crypto exchanges, and Mt. Gox was a massive hole that could not be filled. Out of that came some of the most thoughtful regulation out of Japan to treat Bitcoin as a currency and blossom an industry in Japan. So that out of that calamity came out something good. And all the other ones, there was a Japanese or Korean exchange that lost $500 million and filled the hole with its balance sheet. A lot of the exchanges can't get insurance today, so they are self-insuring. Binance had a SAFU fund that they established and self-insured and paid it out of that. And I think as time goes on and they have better operating mechanics, better cold, warm, hot storage, you'll see insurance get into this space. But right now it's hard for any insurer to make a heads or tails of this. I think on the STO side, you have a framework that's a lot more known. Instead of paper shares, there's going to be tokens, but those tokens are still going to be in form factors that are new and different, albeit they're going to be centralized. So if they get hacked, they could get reversed and reissued a lot easier. So I think the STO piece has got better footing and better clarity in terms of how it's going to operate.
Sure, and it's a lot easier to go find $40 million worth of real estate assets that were tokenized as opposed to $40 million worth of Bitcoins that suddenly went missing. So clearly, I get that. Now here's one that I think we'll probably get opinions from everybody on this panel for it. Everybody's different, but this is really kind of like the driving question that I think most of the conference is looking for. And what do you think? I'll start with Mrinal. What do you think has stopped mass adoption for crypto, and what do you think will change that?
I think, we could go through a laundry list of things, but if I were to categorize it into a few sections, I think there's about 3. One thing that has stopped mass adoption is something I talked about earlier, where there aren't insurance products, there isn't a legal framework. So, and all of these are different forms of recourse, and I'd say people don't know what their recourse is in case something goes wrong. I think what needs to change there is just as the industry matures and you have insurance products, other ways to make sure you can get back at the bad guy, that will really drive mass adoption. And legislators and regulators need to realize the potential of this technology and sort of work with the industry to figure a way to have adequate resource that doesn't also ruin the trustedness of a decentralized network. So that's one. 2, I think there has been a lack of imagination driven by the current state that we're in the industry. What I mean is the best applications and the killer applications haven't been built because people are working from one of 2 mental constraints. Constraint 1 is, hey, if this chain isn't fully decentralized and I feel it's centralized in some form, and there's a chance of collusion, I probably don't want to put something of high value on it because then the value of my transaction is more than the value of what the validators are doing. Or they're like, this chain is super decentralized, but it's very low throughput, so let me build a proof of concept. The combination of these 2 things has sort of been limiting people's imagination. And as chains that are fully decentralized yet scalable come about, I think that'll fix that. And working with more traditional sources of entrepreneurship, where someone with a medical background is building a medical app, someone with an insurance background is building a medical app, a la a Techstars or a Y Combinator, is what's really going to drive the second piece of that adoption. The third and final thing, I don't think the industry has had its Netscape moment yet. I don't know what exactly the Netscape moment is, but the internet, hockey sticked after the browser was invented and, went from enthusiasts to everyone could use it. Right now, most of the experience people have with the blockchain, whether it's setting up a node or wallets, etc., they are cumbersome relative to the apps people are used to and the, way they usually interact with technology. So I think, you solve all these three things. I think that's when we'll hockey stick. In my mind, it's not if, but when.
That's good. Jeff, tell me your thoughts on the same, the same basic question.
As a payment platform, I think one of the biggest issues with mass adoption is that it's inefficient for the most part, or has been inefficient to date, as well as the legal regulatory backing. So in the United States, I don't foresee it ever becoming legal tender, for example, to get that status. And without that status, it'll never receive mainstream adoption because you won't get the affirmation by the government saying, yes, you can use this to buy and sell goods legally, legal tender.
Right.
Just look at what happened in China and how everything got closed down because China saw it as a threat. So that's an issue. And on the asset side, when people say, oh, it's a crypto asset, you're talking about institutional investors, and really, there's no asset behind it. So until these security tokens come out that are linked to hard assets, that will drive the real innovation and the real uptake long term. And I think that unbacked crypto is basically going to be relegated to something that's always on the fringe. I don't see it ever gaining enough momentum to take over the gold base, for example, or hard assets, real estate, currencies. I just don't see it growing because it's unbacked.
I will agree and disagree. I'll agree on STOs and institutional investors getting into crypto to get into assets they understand, a cap table, a hotel, piece of art, etc. And I think tokenizing those assets that people understand, institutions will understand tokenizing the Waldorf Astoria in wherever, but talking about distributed compute, distributed storage, etc., it's like we've all seen the looks on people's faces, like, what are you talking about? So as a on-ramp to tokenize the kind of decentralized tokenized elements of the web and money, etc., the STO is an incredibly important track to get on because it'll give them a new form factors, tokenized representation of ownership, new wallets, new exchanges, new custody platforms. All that infrastructure is brand new. It's all new. And so in a way, it's like training wheels to get institutions to understand the undercurrent. So that's going to be the overcurrent. I think it'll be a bonanza of STO dynamics, and it won't be a straight line, but it'll be a bonanza over the next 3 to 5 years. And the undercurrent of this distributed storage, compute, all this Web3 stuff, and crypto that's unbacked but backed by math, they'll get a better appreciation and comprehension of that. So I think it's kind of both. And so the STO side is going to be, again, I didn't get into crypto for tokenizing hotels and cap tables, but it's an incredibly important way to train institutions. And I think over time, institutions will be like, hey, if I'm in a fund or a real estate REIT or anything else, they're going to be pushing the tokenization narrative because I get better transparency, better liquidity, better price discovery, all those benefits. So so that's where I agree and disagree.
Mance, give me your.
I used this example earlier today.
Okay.
I said when crypto can buy armies, weapons, and the real power centralization of the world, which is essentially that, then I think it could become mainstream. But if it threatens powers to be, which is monetary issuance, then it just won't be allowed to happen. It will be either legal tender, or it's illegal, or they'll be taxed, or there's many ways that existing currency issuers can crush it.
And that's what's in front of us. We are in the forefront of innovating money and decentralized Federal Reserves and money wars and being competitive for what money is. So that's ahead of us. This is kind of like the early innings in many ways.
Mance, mass adoption.
Well, if I had a magic wand, the one thing that I would fix is, or I'd provide is regulatory clarity. I mean, without that, it feels like we're just walking through quicksand. And there are a lot of organizations, enterprises that won't get involved in a meaningful way until there's regulatory clarity. But so that's number one. Outside of that, though, when we were creating Hedera, we tried to outline what do we believe are the obstacles to mass adoption. Some are technical and some are non-technical. And in terms of technical obstacles, performance of the first generation technology was terrible. It still is, right? And it's very expensive. And so that's now being addressed. There are a number of new platforms that are coming out that have much better performance than first and second generation technology, and security as well. Outside of that, there are a couple of issues that I think are important in a sort of meaningful way. And I realize this is maybe controversial, but the entire market is open source, pure open source. And that's been good because it's fostered innovation. It's also had a negative consequence in that everyone understands that the platforms are highly likely to split into competing platforms and competing cryptocurrencies. And that represents risk to any mainstream enterprise business manager that's considering spending several $1 million building an enterprise application on one of these public platforms. If that platform splits, meaning that if there are 100 miners, 30 of them go and create a copy and go create their own network, well, the state of that enterprise application gets forked or copied to go along with the new network. And now you have chaos for the enterprise developer because they have two copies of their application running on two different networks, and their software on smartphones and computers is connecting randomly to both networks. That's a non-starter for a lot, right? So you have to fundamentally solve that problem. If you can solve that problem, then the next question is, what is the organization behind it that's making decisions about governance? What the product roadmap's going to be, when features get released, what are the fees charged for the network, what are the rates paid out to the nodes in the network, et cetera, et cetera. And there has to be a governing body that mainstream organizations trust. Right? They need to look and feel the same to enterprises as what enterprises are used to doing business with in a real way. And so those are the kinds of problems that we've attempted to address. And we're different in that way than many others in the market. But I think that, and I agree, by the way, with just about everything that's been said here and what the obstacles are to mainstream adoption, but those are what we identified as real practical problems that prevent enterprises and small, medium-sized businesses from building applications on top of public networks today.
Got it.
It's funny because the crypto community will say, well, forking and photocopying a different chain is like a feature, not an issue. But then when you're in the enterprise, it's like, yeah, which one am I going on, and what's the distance between that when that decision is made, where everybody's going to go on chain A or B, and so that is an issue on the enterprise side.
Yeah. While I agree with that premise, I won't just to play devil's advocate, and this might be just part of I've been an open source advocate for ages. Linux is so great because it's forked so many times. And you still have Red Hat that gives excellent service. It's a $30 billion company. But the reason Linux is so great, and basically every single server on the planet runs it, is because it's 100% open source and has forked like 100 times. And I think that's the kind of innovation that will lead to an eventual chain here that's so rock solid because everyone's taken something great, made it a bit better, made it a bit better, made it a bit better. I agree, given that there's value on top of these networks, it could be a little messy, but all great things when they're being built are a bit messy.
So I'm a computer scientist as well, right?
Yeah,
and I am a big proponent of open source. The distinction that I would make between any of the other open source projects that are not crypto is that they aren't normally being served up as a service. And if it's the case that an organization is building a product on top of a service, and the service can split or hard fork into competing services, and their application necessarily gets forked across the two services as well. That's not something that you normally see if I'm running Linux to run my web server or whatever.
And most enterprises are running pretty old versions of Linux.
Yeah, fair enough. I'm just saying, like, I don't think there's a black and white answer to it.
There are definite advantages to open source.
Yep.
100% agreed, and it's done wonders for the furtherance of this industry.
Yep.
But there is the downside, in my opinion. There's the downside as well, in that it's also hindered mainstream adoption.
Okay. It says 00.00 left on our clock. I know it's been a long afternoon for many of you. I want to thank you all for coming and listening. I'd like to thank our guests for actually providing all of the knowledge that we've gotten a chance, and hope we learned something new today. Thank you very much.